Welcome back to another episode of Milkshakes, Markets and Madness. Only this week, it's not Milkshakes, Markets and Madness, it's Milkshakes, Markets and Mother's Day. And part of the reason that it's Milkshakes, Markets and not Madness is there hasn't been a whole lot of madness the last couple of weeks. But tomorrow's Mother's Day, and we all know that there's nobody more important than a mother. So if there's any mothers out there listening right now, I hope you have a fantastic day. I hope your family, your husbands and your sons and your daughters treat you like an absolute queen. And if my mom happens to be out there listening, I love you very much. And I appreciate everything you've ever done for me. But now back to milkshakes and markets. Again, we haven't had a whole lot of madness over the last couple of weeks. So what I thought what we would do today is just walk through a number of different charts. And I think you'll see a couple things. One is that we've had a huge bounce in just about everything. And so in many ways, markets are totally synchronized. But there's a few things that are a little bit different that lead to me thinking that we could have a potentially another leg down at some point. So we're going to talk about what that is. And what I thought we'll do here is I'll just pull up some charts and we'll go through it kind of just chart by chart. And I'll just kind of go through how I typically do it on my own, whether I'm doing a podcast or not. And you guys, whatever, you guys can just see kind of how I go through things. But essentially, this is a chart of a number of different risk assets kind of year to date. And, obviously we had a huge, everything kind of went sideways to up for the first 3 months, started to roll over a little bit in March. And then we obviously had the huge leg down here in the first part of April, right? And then we got the bounce and just about everything has bounced. And I think everything is now higher than it was in that early part of April. Oil would be the only one that is potentially not, but everything has had a pretty synchronized bounce. But let's, if we go to this is a chart of the Dow Jones. And so this is a 1 year chart. It's a daily chart, 1 year chart. And you've seen me go over these charts before. And again, it's what I'm showing here up at the top. This is the black line is the Dow. The red, green, and yellow line, these are the moving averages. So the pink is the 50-day moving average, which is short term. The green is the 100-day moving average, which is kind of medium term. And then the yellow, which is the 200-day moving average, which is longer term. Now down below here, we have relative strength. And if we look all the way back here to last August, remember we were really strong on relative strength. And, we were way above kind of the red line. So the red line means you're kind of getting into overbought territory. The green line down here means you're kind of getting into oversold territory. And the further you go either way on those, the higher the likelihood you're going to get a reversal. Now, none of this stuff is guaranteed, but in general, the higher you go and the lower you go, the more likelihood you're going to get a reversal. And then this down below is the stochastics. And stochastics is just, it's very simply, it's a measure of momentum. And when you're really high, you can't get much higher momentum. And when you're really low, you can't get much lower momentum. And so again, those are just indicators that you might be about time for a reversal. Now, the interesting thing here is we obviously had a huge move down in the Dow. And it got so oversold. The relative strength was 20. Now, can it get weaker than that? Yeah, it absolutely can get weaker than that. But anytime you're down in here, you don't want to be putting new kind of hedges or going short down in here. This is when you want to start closing your hedges and think about going long. Now you'll see the stochastics got low, but they didn't get extremely low. They were actually lower, a month before that. So these weren't extremely low, but they were low. And so now we kind of have the reversal. So this is what I think is interesting. Relative strength is kind of in no man's land, not really telling us a whole lot. We kind of broke on the rebound. We kind of broke through the short-term moving average, but we haven't quite got up into either the medium or the long-term average. And what we have right here is we're getting pretty close to the 100-day crossing over the 200-day. That is typically a bearish signal. Now, remember when we had the 50-day crossover, the 100-day here, that's a bearish signal. When you had the 50-day crossover the 200, that's a bearish. But this is kind of a more longer term bearish signal if the 100 crosses over the 200. And so we're not in extreme territory on the RSI, not even close. We're just kind of in no man's land. But we're in the 90s, 92 on momentum. That's pretty high. Now, it can obviously get a little bit higher, but I guess my point is because we're kind of in no man's land right now, I'm not necessarily expecting any super fireworks tomorrow or the next day. I mean, maybe it happens, but the chart is not jumping out to me extremely bearish right now. But if we were to move down the road a couple of weeks, late May, early June, and now we've got this line crossing this line, and we got this starting to run out of steam and just kind of going sideways. We've got the stochastics starting to roll over and the relative strength still in no man's land. Then that might be an opportunity to go short again. Or if you don't have any hedges, well, if you don't have any hedges at all, I would recommend starting to put them on. But my point is I don't necessarily expect a huge drawdown right away. My guess is that it'll be more like the early June timeframe, but I've said many times, you've heard me say before, I think this year is going to be like 2022. And in 2022, from January to September, we saw a 25% drawdown. But it didn't happen in a straight line, and there were several big rallies along the way. Well, we've just had anywhere from a 10 to 20% rally in risk assets, depending on which index you're looking at. And so if we're going to get another leg down, I think we're kind of getting into the area where we're probably going to start to roll over and do that. And in that environment, I wouldn't expect the relative strength to get all the way back up here into extreme territory. And so the fact that we've had to bounce up in here and now it's not really surging higher, but the stochastics have gotten pretty high, and we've got this kind of coming up, it's kind of leading me to believe, well, it's not necessarily imminent. It's probably likely that we're going to get another drawdown. So let's look at the S&P 500. Okay, so this is the S&P 500. Pretty similar looking chart. Again, went back up through the short-term moving average. Haven't quite gotten to the 200-day moving average. And again, we've got the 100-day getting pretty close to the 200-day. We've got the same thing in stochastics. Stochastics have had a huge rebound up into extreme territory. Now, remember, it's at 93. It can't go any higher than 100. So, I mean, this is pretty high. It can occasionally get higher than this, but not often, and certainly not if we're in a bear market. And again, we've got the RSI, which is kind of just leveling out, and it hasn't really made a whole lot of progress over the last week or so. Also, it's not indicated on this chart, but there's a sentiment gauge that I look at, and the sentiment gauge is it's around 70. And so again, it's not super strong, but it's not super weak. It's a little bit in no man's land. But again, I wouldn't expect it to go all the way back up into the 90s, which would be extreme if we're going to have a 2022 type scenario where it continues to play out. So this is, again, while we're not in, I don't have a super strong signal right now saying you need to go short or you need to add a ton of hedges right now, but we're setting up for it, I guess is the right way to say it. Now let's look at the NASDAQ. If we look at the NASDAQ, again, kind of a similar thing. Now here, we had a very strong bounce. We've come back up through the short-term moving average, and it's kind of bumped its head against the 200-day moving average, came down, went back up again, almost touched it. And so that 200-day moving average is kind of acting like resistance so far. And again, it's not quite as close, but again, in a few weeks from now, it's very possible we're going to have another, bearish cross of the 100-day over the 200-day. Same thing in the RSI, very middle of the road, kind of no man's land, isn't really giving me a whole lot of a signal. But again, look at the stochastics. They're all the way up at 95, almost 96, and you can see they're starting to roll over. And part of the reason they're starting to roll over is they have to. There's nowhere else for them to go. And so whenever you're putting trades on, you kind of have to understand what gives the market energy to move in a certain direction. If everybody is long, like let's go back here to last August or last July, right? You had RSI, in the, way above the overbought signal. We have the stochastics all the way up in the 90s. The price is just running higher. It's nowhere even close to the moving averages. That means everybody's long. If everybody's long, that is the energy. They provide the energy that when it rolls over, now they have to sell, and that's what drives the price down, right? So let's now take the opposite. We come back here to a month ago in the first week of April. Now back here, the RSI was way overbought. Now, as you can see the screen, it's way oversold. Back here, stochastics were way at the top end. Now back here, they're way at the bottom end. And now everybody's scared, and everybody's either short or selling, right? Or they're buying hedges. So now that everybody has sold or is shorting or has bought hedges, they are now the fuel that when you start to get a bounce, they have to start covering either their shorts, or they have to start covering their hedges. They have to buy calls to hedge their hedges, and they then become the fuel to send it back higher. And so we're not at an extreme place right now like we were last July for the longs to get trapped, but we're getting pretty close. And so again, it wouldn't surprise me if sometime in the next 2 or 3 weeks, we see another rollover here. Okay, let's look at the Russell 2000. I'm just going to kind of go through a bunch of different markets that I typically go through. Now here, this market sold off a lot more, and it has bounced, but it hasn't quite got back up to its even 100 or 200 day. It is a little bit through the 50 day. It's already had its bearish cross of the 100 day over the 200 day. Again, RSI in no man's land, but we're in the 90s on stochastic. So if overall markets roll over, I would expect this to do the same. But let's start looking at these are all US markets. So let's start to look at some foreign markets, because foreign markets had the same pattern. The DAX has had a huge bounce. The DAX is the German index. So the DAX went all the way down, even below the 200-day moving average. It got very oversold. Its stochastics got to 4. Or no, like 5 or 6. I mean, it's when you see all of these things lining up, when you see a market sell off 20%, 10-20%, and you see relative strength go from overbought to oversold, and you see stochastics go from the 90s to the single digits all over a few weeks, markets don't go in straight lines. You're due for a bounce. So if you're trying to figure out, if I have hedges on, when do I pull them? When do I remove them? When do I start to sell them? Well, the reason when you start to sell them is when you see the dramatic move down, you see the fear in the market, everything gets oversold on a relative strength basis, and everything gets oversold on a stochastics basis. That's how you would make that decision to either pull your hedges or go long or put cash to work or whatever it is. But we have seen a massive rebound in the DAX. And not only has it rebounded and gone back to its high, it's actually made new all-time highs. So this is a case where I feel like there's a lot of longs that could potentially very much get trapped if things were to roll over. Again, the relative strength is a little bit no man's land, but it's getting pretty close to overbought. Not quite, but another week or two could be very overbought. And again, look at its stochastics. It's at like 98. Again, it just can't go much higher. So if you're looking for a place to hedge, or if you're looking for a place to play the other way, I think this would probably be a pretty good place to do it. Let's look at the Euro stocks. The Euro stocks is kind of like the Dow Jones of Europe, I guess is probably the right way to say it. And so, it's going to look pretty similar. Again, huge, just a massive sell-off, right? A 10-15% sell-off, huge ramp higher, relative strength in the middle of nowhere, stochastics back up in the 90s. So what I think is interesting about all this is everything is kind of reacting very similarly. Not exactly the same, but very similarly, which kind of tells me that it's kind of globally synchronized risk. both on and off. And I feel like if we get one piece of bad news for one part of the world, it's probably going to be bad news for the whole part of the world. Unless if this correlation breaks, again, there's no guarantees. But as things are trading right now, the point I would make is I would be more likely to be buying puts or hedging on something like the DAX or the Euro stocks than I would be on the Russell 2000, because the Russell 2000 hasn't bounced as much, right? These have really bounced all the way back up. And again, back in the 90s on the momentum scale. But let's shift over. Let's go look at the Nikkei. So if we look at the Nikkei, again, you're going to see pretty much the same thing. But now it ran right through the 50-day moving average, but now it's kind of bumping its head up against both the 50-day and the 200-day. And remember when I said about when the green crosses over the yellow, you can see that right here. So right when that green crossed over the yellow, that's when you saw the huge drop down in the Nikkei. So now the Nikkei's had, like a 15, 20% bounce. Now it's got some resistance here. Again, not quite into oversold or overbought territory on the RSI, but it's at 98 on the momentum. Again, it doesn't mean there has to be a crash. It doesn't even mean there needs to be a rollover. But it's very unlikely you're going to continue to see a rally at the same pace that you have, because again, momentum, it can't get much higher than it already is. So again, not a guarantee of a crash, but probably not going to see the same pace of improvement. So if you're looking to add some downside exposure, this would be a place to potentially look. Let's look at Korea. Same thing, right? Look at huge bounce all the way. Actually went back through all of the moving averages. Relative strength in no man's land. Momentum at 99, 98. Again, this is something I would be looking at if I was trying to get some downside exposure, especially if global risk continues to stay synchronized. If we go over to Hong Kong, I think you're going to see pretty similar. Yep, pretty similar. It went all the way down to the 200-day moving average, bounced perfectly, and is now at the 50-day moving average. So again, not a bad place to be looking. It hasn't bounced as much. I would say both of these are kind of in no man's land. Again, RSI in the mid 50s and stochastics in the 70s. This would be a tougher one to put on. But it also didn't have quite as severe as a drawdown as everybody else. So that might be something you want to think about. Let's go to Shanghai. Okay. So this is China's stock market. Again, same pattern, significant drawdown, got very oversold. Stochastics got all the way down into the single digits, and now it's ramped up. Again, kind of in no man's land on both of these. So not as big a trigger as some of the other ones that we saw. Let's look at Brazil. Let's see what Brazil's doing. That's iShares. Hold on. Okay, so this is the Brazilian stock market. Again, huge rally, almost back to its all-time high. Not quite, but pretty close. And again, you can see here the RSI is in no man's land, but the stochastics are actually kind of starting to roll over already. And so you can see here the momentum is starting to slow. And so if you were to see this kind of roll over, and you would see this start to come down, and you would start to see just risk in the overall marketplace play off, I feel like this has a chance to kind of revisit these lows. Let's look at so what we've seen so far is everything looks very similar, right? I'm going to pull up the VIX now. Now, I don't necessarily think that you can use relative strength and stochastics on the VIX the same way you can on stocks, but I do think it's interesting because it's pulled all the way back to kind of the 100-day moving average. You can see where it got very, very overbought. But just previous to that, what's really interesting is just previous to getting very overbought, The stochastics were way down here around 10. This is what can happen on the VIX. The VIX can just go from being totally asleep to totally, spiking, a few days later. And then now look, the stochastics are around 3. So again, it doesn't necessarily mean the VIX is going to explode higher, but the momentum is just dead, right? And so could it just kind of go sideways, and could the VIX go back into the high teens or even 15? Yeah, it could. But I don't know if we're going to get lucky enough to have the VIX go back to 15. Now, if it does, to me, it's a gift, because I think this is going to continue to have a lot of risk this year. If you're going to be putting any kind of hedges on or any downside protection on, you want to do it when the VIX is low. So, the fact that we're back into the low 20s, it's not super cheap, but it's not super expensive either. Again, I think if we get below 20, it's probably a bit of a gift. But I just don't know if we're going to get that low. And when I look and I see how low the stochastics already are, I think if we're kind of still in these levels over the next couple of weeks, you're probably going to want some kind of protection over the summer. So as the VIX gets lower, the protection gets cheaper and cheaper. Let's pull up copper. So this is what I think is interesting. So far, if you just looked at the top chart, just look at the price chart, and you didn't look at the RSI, and you didn't look at the VIX, or you didn't look at the stochastics, and you didn't look at sentiment, and you just looked at charts, you'd say, holy cow, this is a fantastic rally. We're off to the races. But when you look at a couple things like copper, it's not quite as clear, because, it had a big bounce, but then it's already kind of started to roll over, right? And it was very overbought, had a huge sell-off, got very oversold, huge bounce. But here, the stochastics, they didn't even get to overbought before they started to roll over. And, copper is kind of one of those, they call it Dr. Copper. It's kind of one of those things that kind of a global bellwether. And if we're off to a, huge global growth, you would expect to see copper much higher. And really rock and roll. Now, I suppose you could have copper going higher on, supply issues, geopolitical uncertainty issues. But from a pure economic perspective, this to me doesn't look like a great chart. If you sell off and you bounce and then you start to roll over again, and especially if you're using 2022 kind of as your base case, then this chart kind of indicates to me that the rebound may be starting to get a little bit long in the tooth. Again, no guarantees, but just this isn't screaming to me that we're on the verge of a new bull market. The other one that is kind of similar is oil. So let's pull up oil. So again, if you were in a globally expanding economic environment, you would expect energy prices to be rising, but it just keeps falling, and it's it got as low as 57 or 58, and now it's bounced up back above 60, but it's a pretty weak bounce so far. The stochastics are way down here, pretty low. The RSI is kind of in no man's land. So this would actually be where the indicators are. This would be more of a buy than a sell. So I'm not sitting here and saying to go short oil. I'm just saying the fact that it had such a hard sell-off and it's only rebounded a little bit, it's not exactly telling me that we're rocking and rolling here. Now, of course, there's few things that are more geopolitically sensitive than oil. And so if we had some kind of a military outbreak or some kind of further geopolitical disintegration, lack of cooperation, then you could certainly see it jump on some kind of supply concerns or demand from military needs. But again, just from a pure economic perspective, this is not exactly a chart that's screaming to me we're due for a hugely expanding economic environment. So I think when you combine oil and copper in conjunction with the fact that the charts to me look like they're starting to roll over or potentially going to roll over, it just kind of gives me pause. Okay, so let's look at gold. So this is going to be futures. This isn't spot, but if we look at futures, I mean, gold's just done phenomenally well all year. And it's just, for the last year, it's just kind of been up and to the right. Again, it's a little bit in no man's land right now. So it's not a super bullish chart, certainly not a super bearish chart at this point. But there's nothing screaming either buy or sell at this point. Stochastics, 70s, so it's not either oversold or overbought. And the relative strength is in the mid 50s. Well, let's just look at silver while we're here. Silver hasn't done as well as gold. Silver's actually kind of, I think it's up 10% for the year. So it's done well, but over the last year, it's kind of flat. It hasn't had the same juice that gold has had. And again, stochastics and relative strength are both kind of in no man's land. So nothing really jumping out at me. The only small thing I would say is it's kind of bumping up against this short-term moving average as potential resistance. But again, nothing's really jumping out at me on this chart. So let's move over to some currencies. Let's look at some currencies. Here we've got the euro, right? Now, we obviously had the huge spike higher. And so it got very overbought. And the stochastics got up to 96, and it has started to roll over. And so, again, nothing is screaming at me saying this is going to jump back up here anytime soon. My guess is that it would come down here and to retest some of these moving averages at a minimum. Stochastics jumped here and have rolled over, and could it flip back up and jump up here? Sure, it could, but my guess is that it would come down here and retest that oversold zone before making a major move higher. Let's look at the yen. Now, when we look at the yen, the chart going higher is actually the yen weakening, and it going lower is it strengthening. So here the yen was strengthening, kind of strengthening all year. And then over the last couple of weeks, it started to bounce and get a little bit weaker. And so, it had down here when this is when it was very strong, right? So you kind of got to flip it in your head. The stochastics were all the way down at 1, which means it couldn't get much stronger. Again, flip this in your head. And you had relative strength at 28, so it was very oversold, but on this chart, it means it's strong. And so it was due for a pullback, and that's what we're seeing now. One thing is we're getting pretty close to this moving average. So if it hits that as resistance, then maybe it comes back down, but it could also jump back up into here. Anyway, let's look at let's look at the Great British Pound. So the British pound had made a high last year, hard sell-off into early January, and then a huge move higher. And it's relative strength out a little overbought, not severely, but again, its momentum got up into the 90s, and it has started to roll over now, and it's kind of coming back down. We'll have to wait and see where it goes from here. Now, again, I think with all of this, I'm not necessarily showing you these charts because I see a great trade on any of them. I just kind of want to get across to you that when you're above, kind of 70 on the RSI, that's the time to start thinking that it's potentially going to pull back. When it gets below 30 on the RSI, it's probably getting oversold. And you can use these stochastic measurements to tell you whether something is really, really moving hard one way or the other. And it just helps get the odds more on your side if and when you either want to go long or go short. Let's look at the yuan. So we did a whole show on the yuan last week. So if you didn't watch that, go back and watch that, because I think the yuan has been under a lot of pressure over the last couple of years, and I think it's going to continue to stay that way. Now, see here is the chart as it goes higher, it's getting weaker, and as it goes lower, it's getting stronger. So again, it got very kind of overbought, which means it was very weak, and then it has since rolled down. But now we're all the way back down into 12, right? wouldn't take a whole lot for it to, if it gets a little lower, then perhaps you're going to start to see it go back up this way. And I think if anything, that's very likely. Again, watch last week's show. I go through in detail why this chart has the potential to go all the way up into here, much, much higher. And if the peg breaks, it could get really, really ugly. You know what? We're gonna go over to one more thing, and we're gonna end on this one because I think there's been a lot. Well, hold on. Let me just, before I get too far ahead of myself. This is the Taiwan dollar. This is a pretty extreme chart, and I brought this up for a couple reasons. So again, as the chart goes up, that's the Taiwan dollar weakening, and as it falls, that's the Taiwan dollar getting stronger. Okay, so it wasn't that long ago, a month ago, it was very, very weak. Right up here, it's very, very weak. And then, as the trade deal played out, it got a little bit stronger. And then last week, huge, absolutely huge move, a 10% move, which, listen, a 10% move for a currency is enormous. It's not like a stock. It's not like NVIDIA. A 10% move for a currency is absolutely enormous. And when that happened over the last couple of weeks, or when that happened, and as the dollar, well, the interesting thing is the dollar got really weak a couple weeks ago, but then has started to bounce. We'll go over the dollar here in a second. But last week, the story was the Taiwan dollar, the Singapore dollar, and some other Asian currencies were strengthening versus the dollar. And this big move in the Taiwan dollar was, again, it's an incredible move. It's a huge move. And of course, it got a lot of people saying, this is the rest of the world rejecting the dollar. They're no longer going to use the dollar. They're going to use their local currencies. Well, that's not exactly true. I don't know how to say this any way other than to say, when you see a move like this is not just a couple traders getting up one day and saying, you know what, I think we're gonna kind of reallocate our portfolio. This is something breaking. This is either something breaking or something unexpected happening, or everybody at once just panicking for some unexpected reason. This is just not a normal move. And in fact, it got so oversold. The relative strength got all the way down to 9. That is extreme move. The stochastics are down at 4 or 5. That is extreme. Okay. So what happened here? So the best way for me to, it is all related to the trade tariffs deal going on, and the fact that it was 30 days after Trump put huge tariffs on the rest of the world. And the best way for me to explain this is I'm just going to go, I'm going to remove this and I'm going to put this up here. There's this guy on Twitter that explained it. He explained it better than I can explain it. So I'm just going to read what he wrote. And I just came across this guy, and he has put out some really good work. I've never spoken to him. I may speak to him, but I haven't spoken to him yet. But I would recommend following him because, he's got his finger on the pulse of what's going on here. So his name is Amit Noam Tal. On Twitter, his handle is at Amital13. Okay. So I'm just going to read you what he wrote because he lays it out perfectly. Okay. So he says, Taiwan's currency shock. When supply chains break, FX markets tremble. And this is because trade is done in US dollars, but sometimes home companies, home insurance companies, home entities have to hedge their currency exposure. And that's what this is related to. Okay. So the Taiwan dollar has recorded its most significant surge since 1980, appreciating by 9% against the US dollar in recent days, before Taiwan's central bank intervened to moderate the currency's rapid strengthening. The past few days have witnessed a rare combination of real economic activity and heightened hedging demand. However, this storm is merely the beginning. In my previous post, and I would recommend you go read the previous post as well. In my previous post, I noted supply chains, much like fine dining experience at a luxury restaurant, appear polished and seamless on the surface. But beneath lies a complex global network of coordination, interdependence, and world-spanning logistics. When a supply chain breaks, the entire system grinds to a halt. Okay. The current disruption in the Taiwan dollar was triggered by the breakdown of supply chains. Again, remember, the ships are not sailing back and forth between the United States and Asia and Europe and everywhere else. And as we have discussed many times, this is not a one-sided thing. If the ships are not arriving in the United States, then they're stuck in port in Asia or Europe or wherever they are, and the inventory is just sitting over there. And if our shelves are going empty, then they're losing revenue, right? This is all part of that. So this current disruption in the TWED market was triggered by the breakdown of supply chains. To understand why, it's essential to examine the intricacies of production and payment terms. So again, when you go buy something at the store, it's an immediate transaction. You hand them the money, they hand you the product. But when you're importing stuff, they will send it and you have, 20, 30, 60 days, sometimes 90 to pay, right? And so there's a lag time between when the products arrive and when payment arrives. So you have to kind of factor all of these logistics, not just of the inventory, but the logistics of the payments arriving. Okay, so exports from China to the U.S. halted on April 3rd, with a particular impact on April 10th, following the announcement of the tariffs as high as 145% on Chinese exports. These tariffs directly affect Taiwan, as they are determined based on where the last substantial transformation occurs. For instance, if Foxconn manufactures in China, the applicable tariff rate is that of China. Approximately 55% of Taiwan's exports to the U.S. undergo their last substantial transformation in China. Bottom line, a sharp decline or a complete cessation of Taiwan's exports to the U.S. is anticipated since April 3rd. Now to the critical part. It takes T plus 30 days for goods from Taiwan to reach the U.S., including unloading, with payments to the Taiwanese suppliers also settled on a T plus 30 basis. Between T and T plus 30, between the time it starts and between the time it actually arrives, Taiwan export orders are exposed to foreign currency risks, necessitating hedging, which impacts the basis market and futures financing. Okay. As long as payments are pending, these hedges remain active and are rolled over. The trade halt on April 3rd created a single bucket of 30-day hedging contracts. Between April 29th and April 30th, the entire bucket was closed simultaneously. Remember when I said earlier, when you see a chart that looked like that, that is not just a couple people waking up one day and deciding they're going to do something different. That is something breaking. That is something all happening at once. That is a massive dislocation. So that's what's happening here. Between April 29th and April 30th, this entire bucket was closed simultaneously, significantly weakening future demand for the U.S. dollar in Taiwan. Then came the insurance companies. This amplifies the event. Taiwan's insurance sector has long been significant, but has grown into a formidable force over the past decade and a half. The total assets managed by insurance companies equate to 140% of Taiwan's GDP, with the majority held overseas. This makes them highly sensitive to TWD or Taiwan dollar appreciation, as a weakening US dollar would lead to losses while their liabilities remain fixed. So again, this is a carry trade gone wrong. You guys have heard me talk about carry trades before. And in our Macro Alchemist, we've written about carry trades blowing up. And almost every financial crisis of the last 50 years has either been triggered or significantly affected by one fiat currency moving very quickly versus another fiat currency. Okay? So again, as he says here, this makes them highly sensitive to TWD appreciation, as a weakening US dollar would lead to losses while their liabilities remain fixed. Again, a carry trade. Regulatory requirements mandate that these companies adjust and hedge their FX exposure. The unwinding of hedges by exporters forced insurance companies to make rapid adjustments. The result, a swift surge in the TWE and a historically unprecedented event. Okay, so that explains the move. But as he says, this is only phase one. And this is only one side of the coin. The supply chain is not merely a logistical system. It is, in essence, an inverse payment chain. When exports cease, so do revenues. This is what I was talking about. If our shelves go empty in the United States, that means the bank accounts go empty overseas. So again, in essence, it's an inverse payment chain. When exports cease, so do revenues. As time progresses, more companies will face cash flow deficits. The current relief in the US dollar is temporary. Okay. So I recommend you guys go follow this guy, and you can read about this in more detail. But I think he absolutely nails it, and I think he's a good source to kind of understand the intricacies of this stuff. So let's go back to this now. So now I'm going to pull up the dollar index, and we'll finish here because I know we've kind of rambled on longer than expected. So now we look at the dollar index, right? Now it obviously, has been selling off all year. It got pretty weak. It got very oversold. Stochastics. Look at the stochastics. 2, 1. I mean, nothing that I promise you've never seen stochastics lower than that because they can't go any lower than that. And this is extremely oversold. And so now the dollar has been bouncing. Now, do I know for sure that the dollar is going to continue bouncing here? No, maybe it'll go sideways. Maybe it'll go down. Maybe they'll figure out this beautiful trade deal and they'll get the dollar into the mid 90s and we'll have another couple of years where markets go up and, like we did from 2021 to 2024. Maybe that'll happen. I don't know. But I'll tell you, it doesn't bode well for the world that the dollar got this oversold and it was still at 98. Because if it's back up in here, that's bad for the world. For the dollar to be this oversold on a relative strength and a stochastics level and the sentiment level, I mean, there was 3 weeks in a row where the Economist was saying, it's kind of over for the dollar in the US. For things to be that low, you would almost expect the dollar to be in the low 90s, maybe even the high 80s. But for it to be this washed out and still be around 100, if it actually starts to rebound from these extremely oversold levels, it could be back up in here pretty quickly. And if that happens, then it makes a lot of sense that we're going to have another leg down in the overall markets that we just went over. And that's why I think it's possible that again, 2025 ends up looking like 2022. So far, the analog is working pretty good. I don't think anything has been solved. I expect the tariff volatility to continue. We had a hard sell-off. We've had a big rebound. I think the rebound's getting long in the tooth. Not necessarily an imminent rollover, but I think it's starting to roll over. And I think by the time we get to the end of June, we will have had that rollover happen. Anyway, that was a much longer episode than I anticipated it being, but I'm glad you guys stuck around. Again, happy Mother's Day to all the mothers out there, and we'll check in with you guys again next week. All right, have a good one. Bye-bye.